Hello everyone, this is Jim Hall from Affinity Wealth Management with an educational economic update for December 2016. In this month's video, we'll discuss some of the major headlines that influenced markets in November and provide insight in what these developments could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. Looking back on November, no one could argue that it was a boring month. After a long, exhausting presidential campaign, Election Day brought results that few people were expecting. Just that day, the New York Times had given Hillary Clinton an 85% likelihood of winning, based on a number of polls, both state and national. We all know how the story actually played out. And what might even be more surprising than Donald Trump's victory is how the markets responded. Rather than experiencing the sell-offs that many experts predicted, the major indexes have shown tremendous growth since the election. In fact, the Dow added over 1,000 points in November and went above 19,000 points for the first time ever. The S&P 500 and NASDAQ also reached record highs last month. And these noteworthy market increases are just a few of the positive economic indicators we saw in November. In my last monthly video, I talked about how the gross domestic product, or GDP, had its biggest gain in 2 years, showing that the economy was growing more quickly than most economists expected. Well, when the government released its revised GDP numbers in November, they revealed that the economy grew even faster than previously thought. After years of sluggish growth, we're happy to see the economy picking up its pace once again. The employment picture is showing an equally positive outlook. Unemployment remains low and personal income gained another 0.6% in October. If you look at this year's gains as an annual rate, incomes are up 5%. These meaningful increases mean that Americans have more money in their pockets and will likely increase their spending to match. Consumer spending is already up 4.2% over last year, and we anticipate it will continue to grow, thanks to greater personal incomes and low unemployment. Since consumer spending accounts for more than 2/3 of GDP, the combination of stronger employment, wages, and spending could help advance our economy even faster. We expect that rising income and consumer spending will result in a holiday shopping season, which will further help GDP growth. One place where Americans may feel a budget tightening is when they go to the gas station. On November 30th, OPEC, the cartel of 8 oil-producing countries, agreed to at least somewhat limit their supply to the markets in hopes of driving crude oil prices above their currently low levels. As a result, you may experience higher gas prices in coming months, but we don't anticipate crude oil will climb anywhere near the record highs of 2008, which were nearly 3 times more expensive than what the market is currently paying. These days, the U.S. and other countries outside of OPEC produce more oil than in the past, which helps to keep the prices lower than during the Great Recession. As we look across the data for November and 2016 as a whole, we believe the economy is continuing to strengthen. All signs currently point to a Federal Reserve raising interest rates when it meets in December. Fortunately, the markets and economy seem poised to withstand moving back towards more historically normal rates. Between Brexit, the U.S. presidential election, and more, this year has reminded us again and again that no one can predict the future. But I'm happy to say that recent economic reports and market performance give us many reasons to be thankful and to look toward the future with anticipation. That's it for this month's Education Economic Update. Once again, this is Jim Hall with Affinity Wealth Management, signing off for the month of December 2016. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 302-652-6767, and one of our advisors would be happy to talk to you. Now for a required disclosure. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Past performance does not guarantee future results. The Standard & Poor's, or S&P 500, is an unmanaged group of securities considered to be representative of the stock market in general. The Dow Jones Industrial Average is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the NASDAQ. The Dow Jones Industrial Average, or DJIA, was invented by Charles Dow back in 1896. The NASDAQ Composite is an index of common stocks and similar securities listed on the NASDAQ stock market and is considered a broad indicator of the performance of stocks of technology companies and growth companies. You cannot invest directly in an index. Thank you.